I'm Daniel.
And I'm Miro.
So if you just glanced at the S&P 500 today, which is Wednesday, July 22, 2026, you probably saw a flat line and, thought it was just a completely boring, zero movement kind of day.
Yeah, totally flat on the surface.
Right. I mean, the index settled essentially unchanged at 7,498.96. But beneath that surface calm, we just watched the geopolitical equivalent of an earthquake, a pipeline shutdown, and a $200 billion AI power grid panic all just sort of collide in real time.
It was crazy. The NASDAQ 100 actually swung nearly 400 points intraday.
Which is huge.
Exactly. And we watched the VIX spike all the way to 19.49 before it finally cooled off. The 10-year Treasury yield climbed to 4.657%, and WTI crude just surged to $86.42 a barrel.
Yeah, so the word of the day is definitely subsurface chaos.
Oh, for sure. So in this deep dive, we are unpacking the mechanics behind those massive intraday swings. We'll look at the escalating brinkmanship that's sending oil higher, dive into a really weak 20-year Treasury auction that spooked the bond market, and explore some mega deals proving the AI industry is pivoting hard from silicon chips to physical power grids.
But really quickly, before we jump into all that, a quick reminder for you listening. This deep dive is strictly for market context and discussion only. We're analyzing the news and the data, but this is absolutely not personal investment advice or an investment recommendation.
Right. Always good to get that out of the way.
Definitely. So let's get right into our first core topic, Session 1. What set the stage before the U.S. session?
So to understand the sheer volatility we saw today, you really have to look at the macro backdrop that carried over from Tuesday's prior session. Markets were already digesting the U.S. government imposing a 25% duty on Canadian imports.
Right. And when a headline like that hits, we typically see that tariff exemption stuff acting as supply chain risk discounting across multinational corporate margins.
Exactly.
But for a listener who, maybe doesn't track cross-border logistics every single day, why does a Canadian tariff immediately shake up the broader market like that?
Well, just think about how integrated the North American economy actually is. When you suddenly drop a 25% friction cost onto one of our largest trading partners, institutional investors just instantly start pricing in higher input costs.
Yeah, that makes sense.
Right. So if you manufacture cars or process food, your raw materials just got significantly more expensive overnight, and that just eats directly into your profit margins.
Right. But I mean, that tariff tension was really just kind of the appetizer for the day, wasn't it?
Oh, yeah. The dominant overnight narrative was the rapid escalation of the U.S.-Iran conflict. So going into Wednesday morning, U.S. forces had completed an 11th straight night of military strikes against targets in Iran.
And the response from Tehran was not subtle at all.
No, not even a little bit.
Around 4:52 p.m. Eastern Time on Tuesday, Iran's Joint Military Command issued this really stark warning. They explicitly stated that any U.S. strikes on their nuclear facilities would instantly expand the regional war to include strikes on all U.S. and allied interests in the area.
Yeah, and then add a physical supply disruption to that rhetoric. Overnight, and outside of the Middle East entirely, by the way, the Caspian Pipeline Consortium announced they were halting Kazakh oil intake at their Black Sea terminal.
Wow. Due to the tanker attacks.
Exactly. Drone attacks on tankers in the area. So now you have physical non-Middle East supply disruptions adding to this global energy supply stress.
I always struggle with how the market processes these overnight geopolitical escalations. The reflex is usually to treat them like, unpredictable natural disasters.
Like a hurricane or something.
Exactly. A hurricane hits out of nowhere and you just survey the damage. But looking at the measured escalating responses between Washington and Tehran over the last week or two, this seems to require a different lens.
It absolutely does, which is why viewing this geopolitical escalation as game theory brinkmanship is much more accurate than treating it like a weather event. Both sides are aggressively testing each other's red lines, right? They are exchanging localized strikes and making sweeping public threats to establish deterrence.
Right. It's like a high-stakes negotiation through military posturing.
Exactly. Neither side necessarily wants a total regional collapse, but they both need to project strength.
So just to recap this setup for you guys listening, you've got supply chain jitters from the Canadian tariffs combined with escalating geopolitical brinkmanship and actual oil pipeline halts in the Black Sea.
It's a lot to process before the opening bell even rings.
It really is. That combustible mix perfectly set the table for a highly volatile day.
Yeah.
So let's take a brief pause right here to let that sink in before we look at the actual trading day.
Sounds good.
Let's move into our next block. Session 2. What moved markets during U.S. trading hours?
So the major catalyst hit the tape right in the middle of the day.
Yeah, it was wild.
At 12:56 p.m. Eastern Time today, former President Trump posted on Truth Social, threatening to bomb Iranian bridges and power plants if any ships in the Strait of Hormuz are attacked.
And the market reaction was pretty immediate.
Well, especially because by 2:45 p.m. ET, Iran responded with threats to stop all Gulf oil flow entirely and cut off electricity to U.S. regional allies.
Wait, didn't they also say something about mines?
Yeah, the Islamic Revolutionary Guard Corps warned shipping companies that the southern route of the Strait of Hormuz is explicitly mined.
Right. And there's a quick caveat here. We are strictly reporting these events and the resulting market price action. We aren't taking sides or endorsing any political viewpoints whatsoever. But just from a purely market perspective, this is a staggering escalation in rhetoric.
It is, and the market priced it in violently. This barrage of afternoon headlines drove WTI crude to spike, closing at $86.42 a barrel.
And Brent crude.
Brent closed at $93.83. This dynamic is a perfect textbook example of energy shocks acting as multiplicative supply inflation.
Because it hits everything, right?
Exactly. When a global choke point like the Strait of Hormuz, which handles a fifth of global oil trade, is threatened with mines, it doesn't just raise the cost of gas at the pump for you and me.
Right.
It multiplies inflation across literally every sector that requires transportation or manufacturing.
Yeah, which is basically everything. But while energy markets were absorbing that physical threat, the tech sector was dealing with its own geopolitical bombshell on the digital front.
Oh, the IP stuff.
Yeah. So at 10:25 a.m. ET, Trump administration advisor Michael Kratsios formally accused a Chinese company, Moonshot AI, of covertly distilling Anthropic's proprietary AI model.
Which is huge news.
Right. And Treasury Secretary Scott Bessent followed up by warning that sanctions and entity list designations are firmly on the table for this kind of activity.
This really represents a massive shift. Historically, U.S.-China tech tensions were focused on the hardware side, like literally banning the export of physical silicon chips.
Yeah, the export controls.
Right. But now we're seeing the conflict move into the software layer, proprietary IP and model protection. You mentioned distilling, which, for context, model distillation is basically using a massively powerful, highly expensive AI model to covertly train a smaller, cheaper AI model.
So it's essentially industrial espionage via algorithm.
Basically, yeah.
Wow.
Okay.
We have oil spikes and digital IP wars.
Yeah.
But let's shift over to fixed income for a second, because the bond market threw a massive wrench into the gears early this afternoon.
Oh, the 20-year auction? Yeah, that was ugly.
Super ugly.
Yeah.
At 1 p.m. ET, the U.S. Treasury held a $13 billion 20-year bond auction. The headline said it tailed severely, clearing at a high yield of 5.163% with a really soft bid-to-cover ratio of just 2.640.
Yeah.
I really want to unpack this. For the listener who isn't trading government debt every single day, what exactly is an auction tail, and why does a 2.640 bid-to-cover ratio actually matter?
So let's use a real-world analogy. Imagine you're selling your house. You expect 10 eager buyers to show up and bid the price up, right?
Okay, sure.
In the bond market, that ratio of bids to the amount of debt being sold is your bid-to-cover ratio. So a 2.640 ratio means there are only about 2.6 bids for every bond offered.
Which is not great.
No, that is way lower than average. Demand was weak.
So what happens when demand is that weak for government debt?
Well, back to the house analogy. If you only have a few hesitant buyers for your house, you have to drop your asking price to entice them to buy it. In bond terms, when the Treasury drops the price of the bond to get people to buy it, the yield, which is the interest rate it pays out, goes up.
Ah, I see.
Yeah, so an auction tail simply means the Treasury had to offer a much higher yield than the market was expecting just to get all $13 billion worth of bonds sold. The buyers essentially demanded a sweeter deal at the very last second.
And if we look at the broader context, the reason buyers are suddenly demanding a sweeter deal is pretty clear. Just yesterday, Defense Secretary Hegseth requested an urgent $67 billion supplemental funding bill for military operations.
Yeah, noting the Middle East conflict has already cost over $37 billion.
Right. So when you combine that massive emergency deficit spending with today's weak auction, we're really seeing long-end yields acting as a deficit and war risk premium.
Exactly.
Investors are basically looking at the geopolitical chaos and saying, hey, if you want me to lend you money for 20 years while you spend billions on a new conflict, you need to pay me a much higher interest rate to cover that inflation risk.
That is the exact mechanism. Now, Put yourself in the shoes of an equity investor holding utility stocks or real estate trusts.
Okay.
Those sectors are heavily reliant on paying out steady dividends to attract investors. But if the risk-free 20-year government bond is suddenly paying over 5% because of this auction tail, your real estate dividend looks incredibly weak by comparison.
Oh, so that's why they sold off.
Yeah.
Yeah.
This is why we saw bond proxy equities acting as yield casualties today. They just get dumped because their yields can no longer compete with the government's newly inflated rates.
That is a phenomenal breakdown. To summarize the U.S. session, the stock market was trapped in this relentless tug of war. On one side, you had interest rate shocks from a weak 20-year bond auction punishing real estate utilities. And on the other side, you had oil spikes from the U.S.-Iran brinkmanship threatening to compress consumer margins.
It's a tough spot for equities.
Definitely. All right, we're going to take one more quick breather here.
Stick with us as we pivot to the corporate side of the tape.
All right. And we are back, Session 3, Corporate Events Recap and What to Watch next.
Let's dive into artificial intelligence, because this morning we saw a flurry of mega deals that highlight the absolute physical limits of AI development.
Yeah, the numbers on these deals are just insane.
They really are. Bright and early at 8:07 a.m. ET, OpenAI announced a staggering $30 billion project to build a 3.2 gigawatt data center in Georgia.
$30 billion, that's just wild.
I know. And then, literally minutes later at 8:30 a.m. ET, AMD announced a $5 billion equity investment in Anthropic, which includes deploying up to 2 gigawatts of AMD's latest generation GPUs.
To put that into perspective for you listening,
Yeah.
a single gigawatt is roughly the capacity of a nuclear reactor.
Yeah.
It can power roughly 750,000 homes. And OpenAI wants to build a data center requiring over 3 of those. We are watching the AI bottleneck shifting from compute to electricity in real time.
It's unbelievable.
It's no longer just a question of whether you can buy enough custom silicon chips. It's a question of whether you can secure the physical power grid to plug them in.
The infrastructure requirements are unprecedented, and the financial toll of staying in this race was laid completely bare after the closing bell today.
Oh, right, the Alphabet earnings.
Yep. At 4:02 p.m. ET, Alphabet released its Q2 earnings. On the surface, they beat expectations. They noted strong AI search demand and revealed their Gemini models are now processing an unbelievable 22 billion API tokens a minute.
Which sounds great, right?
It does, but they also dropped a bombshell. Alphabet dramatically raised its full-year capital expenditure forecast to a range of $195 billion to $205 billion.
$200 billion in capital expenditure for a single year. That is where I have to question the market's initial positive reaction to their revenue beat. It really feels like investors are completely ignoring AI CapEx as a self-defeating valuation loop.
Oh, absolutely.
I like to think of this like a treadmill that just keeps speeding up. If Alphabet steps off the treadmill, like if they stop spending, they lose the AI race entirely. But if they stay on and spend $200 billion a year just to keep pace with OpenAI, they exhaust all their future free cash flow.
Yeah.
So how does the market actually reconcile that?
Well, usually through what we call multiple compression. When you evaluate a tech company, you pay a premium, a high multiple for their future earnings.
Right, because of growth.
Exactly. But if investors realize that every dollar of future revenue requires spending $2 on data centers and electricity, they're going to pay a much lower premium for that stock today.
Right, the infrastructure costs threaten to consume the software margins entirely.
Completely consume them.
Which, honestly, perfectly sets up today's closing bell joke. Based on what crossed the tape today, between the U.S. and Iran trading threats to bomb power plants, and OpenAI and AMD trying to buy up gigawatts of electricity, it feels like we'll all be trading by candlelight pretty soon.
Oh, man.
But look on the bright side. If the entire power grid goes down, at least you won't have to watch your tech stocks fluctuate in real time. At this rate, the only liquid asset we'll have left is the $86 crude oil we're hoarding in our backyards.
Let's be honest, at $86 a barrel, that backyard crude is outperforming half the tech sector right now anyway.
Seriously, it's not a bad hedge.
But looking ahead, let's run through the key catalysts you need to watch over the next 24 hours.
What's on deck?
First, overnight into Thursday, the primary risk driver is any U.S.-Iran escalation or actual shipping disruptions in the Strait of Hormuz.
We got it.
Second, Thursday morning at 8:15 a.m. ET, we have the European Central Bank policy decision, and that's followed by President Lagarde's press conference.
Always a market mover.
Yep. Third, at 8:30 a.m. ET, U.S. initial jobless claims drop. Fourth, before the U.S. Open on Thursday, brace for a really heavy earnings slate.
Who's reporting?
We've got RTX, Lockheed Martin, Honeywell, T-Mobile, Blackstone, and Comcast.
Wow, that's a lot.
It is. And finally, at 1 p.m. ET tomorrow, the U.S. Treasury holds a 10-year TPS auction. Given today's messy 20-year bond sale, this will be a highly scrutinized test for real rates and inflation expectations.
Those are your vital data points.